Three-month LIBOR rates are at their highest since 2008. Take a look inside the Bloomberg at hashtag BTV2472. You can see the ramp up, particularly in the month of March, that we've seen in LIBOR. I'm showing you some three-month Treasury bills there. The two-year rate as well. Similar story, that tightening in the front end of the curve. Even as financial conditions overall, when you look on a broader basis, still back where we were, I believe, in January of 2017. Now, still with us is Richard Turnill of BlackRock. Richard, you do see opportunity in the front end of the curve with the rates ramping up here.
That's right. You've seen two-year paper rise very significantly over the last few weeks. Now, the market is now fully priced in 3 Fed hikes for this year in total. And for the first time in actually over a decade, you've got two-year yields offering positive real returns after inflation. We'd almost forgotten what that looked like. So there's an opportunity there now where we see limited downside to owning two-year paper, and were we to see an unexpected fall in the economy, the market we think would very quickly look to take out some of those rate hikes. So we see that shorter end paper looking very attractive. We still, though, do see yields moving higher in longer durations, as we think the Fed is going to continue to be steady in raising interest rates. Bill
Gross, I spoke to him last week, and he said the Fed's kind of deluded, for want of a better word, if they think actually they're going to get rates in a 2% inflation world, ultimately above 2%. It simply doesn't work in this kind of environment. Would you agree with that?
We think we'll see the Fed steadily raising. So our base case is we actually could potentially see 4 interest rates hikes this year and potentially another 3 to 4 next year. That we're still in an environment where the short-end interest rates are very low compared to history. That when we look at where interest rates have historically peaked, they've typically peaked somewhere close to nominal GDP growth. That implies that rates could, well go above 3% over the next 2 years. I mean, excuse me, we think the market still has some adjustment to do, not so much for the very short term, but actually when we look out to 2019, 2020, we still think the market's got some further adjustment to do of just how far the Fed's going to raise interest rates.